Good morning, everyone. This is Paula White, your lecturer for Accounting 102, and congratulations, this is week 4. You've gone through a lot in Accounting 101 and 102. In 101, you learned all about transactions. You learned all about transactions and let's see who's on. Someone came out. Okay, you learned all about transactions, how to do debits and credits, how to develop journal entries, how to post those journal entries to the general ledger. From the general ledger, you learned how to make adjusting entries, create a worksheet so that you can actually develop your income statement and balance sheet, including your statement of retained earnings. That was simply Accounting 101, which is a huge accomplishment for all of you. Now, you're in Accounting 102. In week 1, we actually close the books out at the end of the year, basically completing Accounting 101. That's where you zeroed out your revenue accounts and transferred those balances to your income summary. That's where you zeroed out your expense accounts, each and every one of them, and then transferred those balances to income summary. At that point, income summary should have the same balance of your total year income statement. Then you cleared out the third entry is clearing out the balance of the income summary and putting it directly into the capital account. And the fourth entry was to take the drawings, the owner drawings, and zero those out, putting them directly into the capital account. So at the end of the year, you have in your capital account the capital investments, the revenue generated less the expense generated by the operations, less any amounts that the owners took out. That is their total net capital balance, and that's what we've done. And also to prepare for the next fiscal year, our revenue accounts, expense, and drawings accounts have all been set to 0 so they can accept the new year's transactions. So that's what we did in week 1. In week 2, get it up here for a second. We introduced, accounting for sales and accounts receivable, purchases and accounts payable. That's when we really introduced a specialized journal, like a sales journal, and we introduced the purchases journal. The sales journal, instead of recording in a journal entry each and every sale throughout the entire year or throughout the entire month, which could get quite time-consuming if you have a lot of sales, we put them on a specialized ledger where you just keep a running list of all the sales that's happened and how much the sales were and how much the sales tax collected were. And particularly, this is a sales journal for those sales that are accounts receivable. These are the people that didn't pay you cash. These are the people that owe you money. So that's our accounts receivable ledger. And then that's the accounts receivable journal. The accounts receivable ledger. The accounts receivable ledger would be how much each individual customer owes you. So we had all those things going on. It probably felt like you were entering a lot of information in a couple different places, but overall the entries would be less cumbersome than if you did it as every time you had each individual sale. So all of these are to increase controls and reduce chances for human error, as well as simplify the process. And we did the same thing with accounts purchases, with the purchases that we made on accounts payable. Same type of thing. Everything that we purchased that we owe people money for, we put on a purchases journal. Then week 3, I think these headings are off. In week 3, we talked about cash receipts, cash payments, and banking procedures. And today it's about cash receipts journal, the cash payments journal, and banking procedures. So again, just like Accounting 101, we have really covered a lot of material in Accounting 102. And for those of you who are through week 4 with me, you have accomplished a lot and you have learned a lot. So congratulations. In week 4, basically you do have readings. You have a reflection. Just how did the class go? Did you learn a lot? Did you have any surprises? Those type of reflections help me as well as the college. And then you have your final assessment, your final, I believe they're usually multiple choice quizzes. And if you want to practice before you actually take your assessment, because once the assessment has been started, you need to complete it and you can't get it reset. So the practice quiz, you can take, I believe, over and over and over again to practice in order for you to actually then be prepared to take the final assessment. And like always, we have the daily checkpoints. Do not throw those points away. They may seem like a small amount, 5 points, but on the whole, they can make a huge impact on your grade. And you basically do have to do them each day because, for example, today is a Monday. The ones for Monday will be opened up at midnight, this like 10 hours ago, and they will close at midnight. Tuesdays will open at midnight Tuesday morning and close midnight Tuesday evening. So you only have 24 hours to do these each and every day, but don't throw those 5 points away. They may become very important for your grade. So why don't we continue? A couple of things I keep reminding you every single week. Come on. I'm trying to get my home here. I just love the spinning wheel. Okay, live sessions. Live sessions are critically important. Right now, I have 1 student on, and that's awesome. It would be even more awesome if I had 10 students on. However, the first session is an instructional session. This is the one that is the lecture of the whole course of Accounting 102. I shared this lecture with the other instructors teaching Accounting 102 for this mod. This lecture will be shared with all the students in all of those sessions. As a barter, that's what I give to them. What they give to us is the ability for you all to attend their sessions, and basically it's what you need to ask. It's not instructional, it's what are your questions? Where are you confused? Or how are you doing on your homework? What are your issues? These sessions are awesome and very widely used and appreciated. So take advantage of all of this time because these are instructors that are also teaching Accounting 101 and 102 in this exact same mod. So they are in it with you right now. So I suggest you do that. Remember the mega lectures as well as the tutoring center, which is in the Shark Center. So with that, why don't we get started with the PowerPoint presentation? And I have 1 student on, and I'm going to unmute her so I won't have to keep looking at her to see if she's typed in a chat, and that way it makes it a little bit more natural. Are you okay with that?
I'm okay with that.
Okay. So this is a picture of our textbook. So today, like I just mentioned, it's on accounts receivable, cash receipts, cash payments, and banking procedures. So most of our discussions in week 1, 2, and 3 have had one basic common core to it, and that is controls. How do you set up a control? What happens, examples of controls when they weren't set up well? And we talked about fraud and embezzlement. Everything goes around control, and everything should come home to roost today in Chapter 9. So Section 1 will be on cash receipts. And the objectives under cash receipts would be recording the cash receipts in a cash receipts journal, account for cash over short, and discuss what cash over short really is, and post the cash receipts journal to the subsidiary and general ledgers. So this is the receipt of cash. So basically, this is a picture of a cash receipts journal. It is the same type of concept that we had with a sales journal, the purchases journal, and this is a cash receipts journal. We will put here every time we receive cash. And these columns are the actual from this column right here through the end are all columns that will be included in our journal entry that will transfer the total impact of a cash receipts journal for the month. We will make one summarizing journal entry into the general ledger, directly to the general ledger. It will not be made to the general journal and then transfer from the general journal to the ledger. Once we get this done at the end of the month and the totals, these will be posted directly to the general ledger. So the last column is a debit to cash, cash debit. Does that make sense to you, knowing about the cash account?
It does.
It just are assets. So what do you do when you increase an asset? Is it a debit or a credit?
A debit.
The debit. So exactly. So if you receive cash, you expect the journal entry to debit the cash account. So that's what we're going to be doing here. Cash account, we're going to be debiting it. Now, on the credits on this form, we're going to receive cash because someone perhaps paid their accounts receivable off. So they gave us a check to pay us because they have an amount due from a sale. So, and we put that into accounts receivable. So accounts receivable will be credited, reducing it, and cash will be debited. Likewise, the sales journal were sales, but they were all credit sales, sales on credit. But what happens if someone pays you cash? They pay you cash and they're out the door. So we have to deal with cash sales by debiting cash and crediting the account called sales. And every time you have sales, you do have sales taxes. So you have sales taxes payable credit. So the total of sales plus sales tax should be the amount of cash that you received. And there may be other issues that are reasons why you may be receiving cash. And in that situation, this is like an all other catch area. So if you happen to have I don't know, someone gave you cash from, they wanted to buy some supplies from you that weren't inventory. I don't know. So the account would be miscellaneous or other income. Posting reference would be the same, the account number. and then the amount would be the amount that you sold. So this would be like the catch-all for all other things that would be more unusual in nature. Usually, when you receive cash, it's going to be because your customers paid you from previous sales, or because they paid you right now for a current sale. So at this stage, does this make sense?
Not really. I'm just not, I have a question.
Please ask it.
Is this in replace of a cash register?
This is your cash register.
So if you, in today's world, we have very computerized cash registers, we wouldn't use a cash receipts journal. Am I correct?
If you're using a cash register, okay, if you're doing a cash register, all of this will be already, you're right, all of this will be in the cash, the credit sales, I'm sorry, the cash sales and the sales tax payable for the cash sales would already be included in your register tally, your register tapes.
Right.
In the cash register itself, if you're in a retail establishment.
Okay.
Exactly.
All right, I'm good now.
Okay. Good question. I'm glad you asked that. I've seen a lot of people in the service industry, like perhaps a repairman, would come into my house and they would repair the television. And they're working on a more of a manual cash system where they actually have a receipt box and they're writing out the receipt, and then they either get a check or a cash and they put that into the box itself, and they pull off a yellow copy for you, a white copy for them, a pink copy for their office. That would be more of a cash receipts journal.
I got situation. It. Okay.
But going to a grocery store, working in retail, that they actually have a cash register, that would take away from the cash sales column and the sales taxes payable column, because that would be basically your cash register.
Right. Okay.
But you do have other reasons to having a cash journal other than sales.
I relate all of this to like my son's business. So when I work in his flower shop, he has a flower and chocolate shop. So he is very computerized. So even the other account stuff, we have a place on the screen where you can plug all that in. That's why I ask these questions.
This is what you're describing is a computerized version of this.
Right. Yep.
Because you're able to put in other accounts.
Yeah, we are. Yeah.
Okay, good. Well, thank you for bringing that, because you're making me hungry with the chocolates. But,
I'm sorry.
But the cash receipts journal is exactly what you're describing as your mechanical computerized version.
Okay. Sounds good.
Good. Okay, so let's continue. So you debit cash. Now, you probably never have this, which is probably good, but in the register, occasionally errors are made when making change to your customers. And you may have, when you're reconciling the cash drawer of your register to all the sales taken out and all the, when you're balancing your cash drawer at the end of the night, the amount that you had cash in the cash drawer at the beginning of the day, plus all the sales, less all the payments out that you may have made. The end of the day, your cash register should have the same amount of cash in it that it says it should have in it. Sometimes there's an error. Do you ever have any cash overs or shorts?
Yes, we do.
And basically, let's just continue here. Occasionally, errors do occur when making change, and sometimes they're just human errors. Errors happen. The cash in the cash register is either more or less than it's listed on the audit tape. And I want to stay here for a second. A lot of times, businesses think, well, number one, business owners want to minimize these cash over shorts as much as possible. Because if the cash drawer is short, the business got shorted some money, right?
Right.
And that doesn't make the owner happy. I have had clients tell me that they fire people on the spot if the cash drawer is over.
Oh,
Can you think of any reason why that might be?
they're doing something wrong with a customer?
Yeah, somehow they charge the customer more money than they should have.
Yeah.
And if you get a customer mad, they leave your establishment, they will never come back. Will they talk?
Yeah. One bad customer leads to $1,000 loss.
Exactly. A happy customer may not say anything to anybody, but a customer who thinks you cheated them
Yeah.
will badmouth you from now until the end of time, and you will lose a lot of customers.
Yep.
So an easy way of doing that would be to shortchange them. So some businesses actually fire people on the spot for having a cash drawer being over. Because cash over means that you cheated the customer. Cash under or cash short means that your heir is cheating the owner.
Right.
Now, human errors do occur. So what happens when you do that? And we're going to see how this shows up in the cash drawer in the cash register in a minute. You have a customer who has not paid you, has had trouble paying you. Your Max Out Sporting Goods Company, and Stacy, she owes you $800, and she's not paying the accounts receivable. She's having trouble paying you, so you come up with an arrangement with her where you issue a promissory note in place of the accounts receivable. So here the promissory note is dated July 31st for the amount of $800 in 6 months. After the date, 6 months, I promise to pay Max Out Sporting Goods $800 payable at the First Texas Bank, and there's interest on here at 9%. And she signs it, so it's a legal document. So now you've transitioned the accounts receivable in her name into a notes receivable. So
Wow.
let's talk about some special features on that. There's an interest here at 9%, and the principal is 6 months and $800. So the amount owed is $800. The interest rate is 9% a year. Right now, I can say 9% of $800 is $72, and half a year would be, I believe, $36. So let's continue here. Rate for the 6-month period is 9% divided by 2, or 4.5%. So you just simply take $800 times 4.5% to get the interest. This is called simple interest. So the interest amount would be $36. So at the end of 6 months, she owes you the $800 of principal plus the additional $36 that you're charging her for interest at 9% a year for 6 months. Does this make sense to you?
It does, except for the fact is, why is the line in there to the bank?
It could be payable at First Bank. It could be payable at your son's chocolate and flour company. It's
Okay.
just a location.
Oh, okay. Got it.
But good question. maybe you just want to take it to the bank and put it into your own account. Have them put it directly into your account at the bank. I typically like to see the check or the cash and actually make the deposit myself.
Right. Yeah.
So that could be a location, or in this day and age, it could be certainly electronic.
Okay.
I just published a book, and it's out now as of July 1st, and we had to get it printed. We got 5,000 copies printed, and the printers wouldn't send the books out until they got paid 100%.
Yes.
The printers are in New Jersey.
Right.
They happen to be with Wells Fargo Bank, which is right down the street from me. So I wrote a check out of our business account for the amount of the balance. I took it to my bank and had them put it directly into their account number.
Right.
And when I got that deposit slip, I shot a copy of it on my cell phone and emailed it to them.
Oh, isn't this fun?
Yeah, so I didn't have to.
Congratulations on the book.
What?
Congratulations on the book.
Oh, well, thank you. Thank you. It's about, it's called Act 3, your anti-retirement playbook. And it's focused on baby boomers, but anybody going through transitions, your life is more than just money. And I think there's a misnomer out there that retirement is only about, do you have enough to retire on?
Right.
Certainly that's a part of it, but the bigger part, and part that everyone's missing, is living life of purpose. What are you wanting to do in this stage of your life? And can you afford that? And how do you finance that part? So it's if you want to check it out, I have it on myact3.com. MYACT, the number 3.com. And you can see more about myself and my co-author and all. But it is cool, and it is very much of a business that we're into now. And we're doing PR, and we'll be on TV on Friday and all types of stuff. So it's exciting.
You know, I'm so glad for you. I wrote a book as well. It came out in May.
Did you?
But I don't have the money. I wrote a book myself.
Okay, great.
Published the end of May. But I don't have the money to do the marketing like you're doing.
It does take money and effort. I was told to actually become an expert on social media to build your platform.
Oh, is that what it is? Okay.
So if you build it on social media, it's basically pretty much free except for your time.
Right.
So what is your book?
It's called By Choice, and it's about my husband's life, who had a brain injury when he was 16 playing high school football, and my life as a battered woman being married to 2 abusive husbands, and what our lives were like in a parallel situation. So what I was doing while he was trying to recover and so forth, and I was having children and being beaten, and he was trying to recover. And then we met at church, and it's our story about how 2 people who were most unlikely to get together did get together. I was 335 pounds when he met me. Yeah, I don't weigh that now. I lost 150 pounds after gastric bypass. And a lot of this is in the book, not the gastric bypass part, but about how, we accepted each other for what we were. And it's a fabulous book. It's told as a fiction, as a story. Names have been changed, but most of it is pretty much on track.
Wow, that's awesome. Well, congratulations on that.
Thank you.
Just start looking into social media.
Yeah, I will.
And I'm talking Facebook, Twitter, and there's YouTubes all over the place on how to use those tools to market yourself.
Oh, I will. That's fabulous.
Well, congratulations, and I'm sorry for your history, but the history made you who you are today.
It sure did.
It has, both of us.
Wow. So is that your husband in the background?
Yes, it is.
Hello.
Hello, how are you?
Oh,
Oh,
wow. So congratulations. I'm so happy for both of you that you found yourself.
yeah, we did. We've had a great marriage. We've been married for 16 years now.
Wow. Enjoy every
Yeah.
day of it, sir and madam.
Thank you.
Okay. So let's continue on this wonderful thing on accounting. I would love to talk to you about books and stuff, but okay. So, but you know, books are a business too.
Yes.
So in your cash receipts journal, in your world, it would be your son's cash register system. But this is a cash receipts
Right.
journal. And you can see here on the 15th, our cash drawer was over because
Ah,
cash received was higher than we expected it to be. So cash received was over, so that's $18. We wouldn't put a negative here.
Like I just showered.
We would not put a negative here for a cash under. Because this is cash receipts, it would have to be a cash over. The cash short would be on the cash payments ledger. So, and then down here in the last two lines, we have notes receivable because we are Max Sporting Goods, and our customer Stacy actually paid us at the end of 6 months. She paid us the $800 and the interest of $36. So that's our $836. And this is an example of what would go into that other accounts section. Because notes receivable is not sales, and it's not sales taxes, and it's not accounts receivable. So here we would put in the reason that we received this cash of $836 is because $800 of it was collection of a note, and Stacy Fairley actually gave us $36 for interest income. So you see how that works?
I see.
And you know, if your son has a register that actually has that computerized capability, this is exactly what happens there. Because at the
Great.
end of the day, you're depositing $42,612 into the account.
Got it.
Okay, now we just did the happy part of men's life. The sad part is sometimes you have to pay cash out. So we have a cash payments in a cash payments journal, and you post the payments from the payments journal directly to the subsidiary and general ledgers. And we're going to talk about petty cash fund and how the knowledge of internal controls for routines for cash. So, I mean, these journals look kind of similar after a while, don't they?
Yes.
So here, instead of cash receipts, it's cash payments. And here we're going, if we pay out cash, that will reduce the cash account. It will reduce an asset. So a debit or a credit reduces an asset.
Credit.
Credit. And that's why we are in the cash column. That's why we're actually crediting that account. Because these are cash payments, cash goes out, it's a credit to cash, $1,500. So
Right.
here we're actually writing a check for January rent. The account will be rent expense, and the amount will be $1,500. Now, the typical reason why we would write a check would be to pay off accounts payable.
Right.
And everything else would just have to go under the other category. Rent expense, postage expense, any other expense that's not an accounts payable would go under just the actual expense. This way we'll only have to post to the general ledger one time, where when we did accounting 101, we post the general ledger many times every time we wrote a check. So
Right.
this is to also save the same type of effort. Are we good?
Good.
Okay. So basically, this page is the section here in blue, the cash payments journal, page 1, and this is our January rent that we just did for $1,500. Since this is cash payments journal, our posting reference would be CP1 for cash payments journal, page 1, and this is the rent expense account in the general ledger. And then it would be account 634. So that's why we put 634 in the blue section, the cash payments journal under posting reference. That way, when we go to the rent expense account, we can backtrack to exactly the page of the cash payments journal and find where we entered it. And likewise, if we're saying, well, where did this $1,500 go? We can say it went to account number 634. And this is the same as it's been all along with week 2 and 3 in this course.
All right.
Okay?
Okay.
And that's just a banner that says, that's exactly what I just told you. Now, petty cash. Petty cash is it's a petty cash amount. It's an amount of cash that you have on hand that the person who's controlling it is called the petty cashier. It's not a huge job for someone, but they have the locked box of cash. They keep it locked, and they're responsible for recording and keeping track of every reason and the amount when cash got taken out of the cash drawer, of the petty cash drawer. So here is an example of a petty cash voucher. For this situation, it needs to be computer processed or filled out in black ink. That's for control purposes. And someone bought office supplies and they brought back a receipt. And the receipt was for $16.25 and they wanted cash. So the person who's a petty cashier gave them $16.25 out of the petty cash drawer. And the petty cashier got this petty cash voucher along with the any receipt justifying why the $16.25 was spent. And in that situation, it was office supplies. It may be a cash register receipt from Office Depot. And then signed LT Green, office supply, office supply company, and approved. So this is a person bringing in the, asking for the money, and this is the person approving the money. So then the petty cashier gets it, and there goes the $16. Basically, what happens in petty cash, you begin with cash at the beginning of the month, and by the end of the month, all that cash got replaced with receipts and petty cash vouchers. Excuse me. So you have a petty cash voucher number. So let's talk about the internal control procedure for petty cash, and maybe it'll make a little bit more sense. Does your son have petty cash in his business at all?
No, but when I worked in the law firm, we did. And when I've worked in small companies, I've maintained a petty cash drawer.
So this is old news to you, but probably new news to a lot of other people who will be listening to this.
Right.
So internal control procedures to follow for petty cash. It's only used for small payments that cannot be conveniently made by check. So some examples of this could be paid on delivery. Do you ever have the postman come in and they have paid on delivery type of things,
Yes.
and they can't drop the mail off unless postage is already paid,
Right.
and they're there standing, and there's no time to write a check and to
Right.
get it signed. He's dancing in your lobby and he needs to get moving. So pay him the postage and let him go, and then that's a petty cash fund reason.
Yes.
Another reason could be just miscellaneous things that you just need every day in your business, or maybe send someone out for lunch. You're working
Yeah.
everyone through lunch. Take $30 out of the petty cash fund and buy everyone lunch as a business owner, and that would come out of petty cash also.
Yeah, my son needs to do this.
Well, you tell him that your instructor told him he should too.
Yes, right.
Or are you talking about buying you guys' lunch?
Right.
Well,
Yeah,
he
he
should
does
pay,
this a
he should
lot.
pay his mother lunch all the time.
Yes, he does.
Well, good. Okay, so now we need to limit the amount set aside for petty cash to the approximate amount needed to cover 1 month's payments. So you don't have someone responsible for $1,000 in the petty cash fund if on a month-by-month basis you only use $150. Bring that down to $150, $175, and then you're going to be using between $150 and $175 in your business in a month. That's more reasonable. Don't have another $800 sitting out there.
Right.
Likewise, on the other side of the coin, don't have petty cash so tight that you keep having to replenish it throughout the month, because that will take away from the benefit of not having to write checks every time you turn around. So, and basically how it gets funded is you write a petty cash fund check to the person in charge of the fund, not payable to cash. You can make it payable to Paula White, petty cashier, or you can make it payable to petty cash, but you do not make it payable to cash. Excuse me. I need to get a drink of water here.
Yes.
One person is assigned to control the petty cash fund, and that person has sole control of the money and is the only one authorized to make payments from the fund. Is that how your experience was with the law firm?
Yes. Yes, absolutely.
You were the captain of the petty cash.
Yep.
End of story. Because you can't have 10 people with their hands in it.
No.
It's cash, and cash does not have an owner. And you can't have all these people just going in and bringing stuff. If you have cash in a drawer and people keep taking cash out, human nature means that they won't ever remember usually to put a receipt in.
That's right.
And then at the end of the month, someone's in trouble, and it's usually the petty cashier.
Yeah.
Because it controls. So she or he needs to keep the petty cash in a safe, a locked cash box, or a locked drawer. And the petty cash person needs to prepare a petty cash voucher for each payment. The voucher should be signed by the person who receives the money and should show the payment details. And this provides an audit trail for the fund. Remember, this whole course, all the discussions have been all about controls, cash controls, and audit trails. Now, so that's the end of petty cash. Do you have anything to add?
I don't think so, no.
Pretty much covers it?
Yeah.
Okay. So now let's demonstrate a knowledge of internal control routines for cash. This is not petty cash, it's for the cash account and cash in the business. You have only designated employees will receive and handle the cash. In some businesses, employees handling cash are bonded.
Yeah.
So not everyone touches the cash.
Right.
You keep cash receipts in a cash register, a locked cash drawer, or a safe when they are on the premises.
Yep.
Your son with the chocolate and flower business keeps his in a probably a locked cash drawer because that's what a cash register is.
Yes.
Right? Cash
Yes.
register. Make a record of all cash receipts as the funds come into the business. Well, in today's computerized cash registers, they do that automatically.
Yeah.
But record receipts of all the funds that comes into the business, because if you don't, and if it's a fast-moving business, you're going to forget what you received cash for the entire day. And what if you're a business that has service as well as sales? You need to know, as a business owner, you want to know how much you are doing in service business as well as how much inventory you're moving. So you need to have this knowledge anyway. So make a record of all cash receipts as they come into the business. The funds need to be checked check the funds to be deposited against the record made when the cash was received. So at the end of the day, excuse me, at the end of the day, if you have $500 in the cash drawer and your cash register said you had $550 in the cash drawer, you have an issue. Your cash drawer is $50 short. So the employee who checks the deposit is someone other than the one who receives the cash. Why would that be? Would that be a control issue?
It definitely is a control issue, yes.
Yeah. People who receive the deposit, who makes the deposit, needs to be someone different than the one receiving the cash. Deposit cash receipts in the bank promptly. Don't let them hang out day after day. Deposit the funds intact. The person who makes the bank deposit is someone other than the one who receives and other than the person who records the funds. So the person going to the bank is someone totally different, and they bring back a receipt from the bank that says they received so much cash. Enter the receipt transactions in the accounting records promptly. The person who records cash receipts is not the one who receives or deposits the fund. So basically, the whole thing is about dividing the jobs up so that there is a check and balance system, and have the monthly bank statements sent to and reconciled by someone other than the employees handling, recording, and depositing the funds. That's critical too. So many businesses do not reconcile their bank statements. I cannot tell you how many new clients I get and got over the years when I look at their QuickBooks and I said, well, okay, let me just check your QuickBooks out, and I go to their cash register, and none of it has been reconciled.
Oh, man.
I've seen some really, well, they're busy running their business. They're not busy controlling their money, which is why we exist, right?
That's correct.
So essential cash payment controls. This was cash receipts controls.
Oh, you're breaking up.
Oh, okay. Cash receipts controls. Hopefully I'm getting better.
That's better.
Okay. Cash receipts controls is different than the next subject, which is cash payment controls. So how do we control cash payments? Well, you make all payments by check, except for those payments made from special purpose cash funds, what we just discussed, petty cash funds. Everything else gets paid by a check or debit card You know, there are some other things. But issue checks only with an approved bill, invoice, or other documentation that describes the reason for the payment. You just don't write a check because you wrote a check. It has to have some documentation attached to it. Have only the designated personnel approve the bills and invoices. In the law firm, who was that person? Was it the managing partner, probably?
I'm sorry, you were breaking up. I didn't hear you. What did you ask?
Okay. In the law firm, who was a designated person approving the bills and invoices? Was that the managing partner?
No, we had, yeah, I worked for large law firms, so we had a CFO.
Oh, perfect. Okay. And who does it for your son's
Well,
flower and
unfortunately, he's a very tiny place, so he's the one who does it.
yeah, but he's the owner.
He is the owner. He has a lot of hats he has to wear.
Yeah. And that's one reason I kept asking in the discussions. I guess you picked that up. I kept saying, okay, this is great. Now, how would you do it for a small business?
Yeah.
I kept trying to bring it back to what happens when you're a small business.
And you know, a lot of people, they look at small business, they think 50 employees, small business, or 27 employees. They don't stop to think that a small business can exist with 2 employees.
And they do all the time. Just go out your house and make a turn, and within a block, there's probably 3 or 4 independent businesses.
Yeah, and unfortunately, there's not enough people to designate all these tasks to. So for my son, he has a fellow that works with him, and they kind of offset each other. So they do the balance, the checks and balances between themselves.
Exactly, but they both know that there's a checks and balances. So neither one of them is going to do something wrong.
Right.
Because they're doing it together.
That's right.
So yeah. Okay, so have checks prepared and recorded in the checkbook or check register by someone other than the person who approves the payments.
Unfortunately for my son, he's both.
And sometimes he's stuck doing that.
Right.
And you know, prepared and recorded in the checkbook, that could be QuickBooks also, or any type of a software system.
Right.
Sometimes in the past, I've actually had someone in my firm enter the checks to be written or the bills to be written by the owner, and then we would put it up for payment through online banking.
Right.
But the owner would have the only ability, because he would have the only code number to release the payment through online banking of those checks that were sitting out there to be released. So we sat and prepared the whole thing through online banking, QuickBooks and online banking, and then he would come in, and if he approved all of them, he would then send all of them out. If he approved all of them except for 2 of them, he would uncheck mark 2 of them and send the rest of them out.
Oh, cool.
Then we talked about those 2, and it could be something that we didn't know about because he returned all that product and he was unhappy with them, and so okay, we just then made the adjustments to QuickBooks to get rid of that payment and the impact of not having that material anymore because they returned it. So not everything has to stay manual in accounting, because much of accounting has been automated or made so much easier through technology and even apps nowadays.
Yeah.
But the basic premise is the same. Checks are prepared on paper or electronically and recorded in the checkbooks or the software system, and there's a check register that is in the software system, someone other than who approves the payments. So the same thing happens whether it's a paper manual system or a computerized system. Now you still have another person, if possible, sign and mail the checks to the creditors. Well, in my situation that I just discussed, people send online payments every day.
Yeah.
So we didn't have to have another person sign and mail the checks because there was no physical checks to be sent. But yet, in my situation that I discussed, the owner giving his special code that he only he knew, he essentially told the bank to send out the checks on their behalf. And that's what happens.
Right.
And consider requiring that 2 people sign all checks greater than a pre-designated amount. And I totally agree with that. If it's over $5,000, $10,000, $100,000, depending on the business, then there should be 2 people signing checks over those pre-designated amounts. Because one person, no matter what, should not have the ability to just sign the check as one person.
Right.
And simple things, pre-numbered check forms. Don't go to the bank or don't go to us. Do not go to a forms place and buy a whole bunch of blank forms with your check number on it without a numbering system on it. I don't even think you can get pre-numbered checks that aren't pre-numbered, except for those very first few checks that you get. But even those are numbered. They're numbered 001, 002. So I don't think checks even exist now that are not pre-numbered.
Right.
If you find them, don't use them.
Right.
During the bank reconciliation process, you compare the canceled checks to the checkbook or check register. And the person responsible for this should be someone other than the person who prepares or records the checks. That makes sense because they should be canceled, and that should be a different person than the person who wrote the check. Again, for your law firm, that was easy. For your son, it's difficult because your son has probably 2 or 3 at most employees.
Right.
And then mom comes in and helps.
You bet.
Yeah. And then number 8, what? Okay. Then number 8, enter promptly into all accounting records, all cash payment transactions. The person who records cash payments should not be the one who approves payments or the one who writes checks. I think we got all that taken care of now. Business owners that I've worked with want the cash balance in their financial records to be as accurate and as updated as possible at every single moment of the day, because they live looking at the cash balance. So if you didn't post those for a couple days, they don't know where they are in their business. They're the ones responsible for paying payroll, your payroll. They're the ones responsible for having to come up with rent. What happens if they don't have enough money, or they've spent too much money and they don't have enough for rent and payroll that's both due on the 1st of the next month? They have some issues. Oh, okay. I'm having weird little messages.
Yeah.
Are you still seeing me?
Yeah, I am. We're still good.
Okay, it just gave me an error that I'm checking out. I'm not. Okay. No. And the last thing, I need another drink of water. The last thing is banking procedures. Okay, writing a check, maintaining the checkbook balance, reconciling the monthly bank statement, adjusting entries as a result of the bank statement, and how do businesses use online banking to manage cash activities? I kind of already touched on number 11, but let's continue. Sometimes the difference between the bank balance on your bank statement that you get every month and the book balance is due simply to mistakes, human errors. Errors made by the banks could be arithmetic errors. And they could, some other errors are giving credit to the wrong depositor and charging a check against the wrong account. I think these last two errors are less and less likely nowadays. I haven't seen too many of them anymore.
Right.
Errors made by businesses, arithmetic errors. Not recording a check or a deposit, that's real common. Both of these are common. And recording a check or deposit for the wrong amount is also very common.
Mm-hmm.
So there's errors no matter what, but there's basically the same type of errors. And banks usually require that errors be brought to their attention within a very short period of time, let's say 10 days. Because if you delay in reconciling your bank statements, these 10 days will tick by so fast, you will not be able to get the errors corrected if it's in your favor. So the format of a bank reconciliation. First thing you do, you start with the bank statement. And you're comparing the bank statement to your ledger account for cash. So you start with your bank statement balance. And in this section, you're putting in everything that you know about in your company that the bank doesn't know about yet. Perhaps throughout the bank statement period of time, which ended on the 31st, you made a deposit on the 31st, and they don't have that deposit in their records yet. It's really going to be on the 1st for them. So that would be a deposit in transit. It's on your records. It's within the date time frame, yet an adjustment to the bank statement balance will have to be because of that deposit that they got that day, but they haven't posted that transaction. Likewise, just because you write a check and send it in the mail to a vendor or an employee doesn't mean that they're going to cash it immediately. So sometimes you have outstanding checks. So the bank statement needs to be adjusted by deposits it doesn't know about yet as of that date, and checks that you've written that hasn't gone through the banking system yet when checks you've written been cashed by the people that you wrote them to. And plus or minus any bank errors. And that will get you an adjusted bank balance. Guess what? We have to do the same thing on the other side. The second section of a reconciliation statement starts with your book balance. What is on your books right now for the as of the date for the book for the checking account? How about deposits that aren't recorded? Did the bank know something that you didn't know about yet? A deposit that's not recorded would be perhaps the example of printing our book. I actually went to his bank, which was my bank, and deposited one of our checks into that company, the printer's banking account. The accounting department at the printers may not have known that I made that deposit. So that would be a deposit in the printer's account that may not have been recorded, but they need to record it because that was something that the bank knew about, because I went personally to the bank to get them my check to put into that checking account. The bank knew about it, but the printer's accounting department may not have known about it.
Oh.
Deductions. Bank service charges. NSF fees. Hopefully no one knows about NSF fees. Non-sufficient fund fees. Any of those deductions or any errors in the books. Books have errors in them often, just like because they're done by people. So now the book balance has been adjusted by the stuff that the bank knows about, knew about, but the accountant didn't know about to get to the adjusted book balance. The bank statement has been adjusted by everything that the bank didn't know about, but the company did. So at the beginning, the bank statement balance did not equal the book balance. At the end, the adjusted bank balance has to equal the adjusted book balance. That's what this whole reconciliation is all about. Now, to keep your books and records straight, you just reconcile this on a form or on an Excel spreadsheet. That does not mean that the deposits were journalized yet or that the bank fees were journalized. So you need to make journal entries for these things on the book balance side, because these were things that happened to your cash balance, obviously, because the bank knew about it, but you didn't have it in your books yet. So you need to post these into, you have to journalize these transactions into the general journal, then post them to your general ledger. And then you're done with this process. Does this make sense, or are there any questions?
No, it makes sense.
Now, you don't have to answer this, but do you reconcile your own personal checking accounts? Never mind, we know the answer. Your husband talked over you there.
Yes, he did.
Maybe he doesn't do it. So that is basically the end of the lecture. And we kind of gone over the entire course that you have from Accounting 101 and 102. And for everyone who's gotten to this stage, I need to give you a hearty congratulations, because these two courses cover a lot of material. And if you've never been exposed to accounting before, the whole 8 weeks had to have been an experience in a new language, a new system, and a new world. So congratulations to everyone on that. So, Pat, do you have any other questions that you want to ask?
In today's world, we do so much electronic accounting. And no matter if you go looking for a bookkeeping job, they want to know if you know QuickBooks. Does that ever get taught in this college courses that we're taking?
I believe, okay, in a conversation with the assistant dean of accounting, he did mention that in some courses they do have QuickBooks in there.
Oh, good.
But I wouldn't just stop there. I would actually go to QBOA, QuickBooks Online, and I think they even have a trial version that you can have for 30 days, and maybe there's even some versions of QuickBooks you can have just to play with it.
Oh, nice.
Online. So I would go online and play with it, and these versions usually have a sample company.
Oh, good.
That you can play with it and see how it feels and looks, and then we can get like a leg up on your future courses.
Right.
Great question.
Okay.
And that's QBOA.com. If you forget about it, just type in any search window QuickBooks Online.
Great.
And it will take you right to it.
Super.
So, any other questions?
No, I'm good.
Well, Pat, it has been a pleasure. I am so sorry we had a couple stumbling in the first couple of weeks. I hope that's okay now.
Yeah, and then I ended up with medical problems, and that.
Oh, and I hope that's okay too.
Yeah, that's fine. It's going better now.
Okay, well, great. And tell your husband I was glad to meet him virtually. And I'll say goodbye then.
Okay, thank you so much.
Okay, take care.
Okay, bye-bye.
Okay, you too. Bye-bye.